It's the perfect time to start investing. And today we'll be sharing with you where you should invest your money for long-term growth. But before that, what is investing? According to the father of value investing, Benjamin Graham, investing is knowing exactly what you're purchasing. It is indeed one of the best ways to safeguard your financial future. Everything you have put in is secured long-term. On top of this, you are also confident that your investment will generate a sizable return, whether through capital growth or healthy dividends. Graham cautions us against being referred to as an investor when you're actually a speculator. He points out that everyone who engages in the stock market is referred to as an investor. You're not an investor if you buy a stock solely on a hot tip from a pal of yours or your broker. That makes you a speculator, even though you might get a decent investment return on your purchase. One does not instantly become an investor just because they have made an investment. The goal of investing is to build wealth over the long term, to give yourself passive income to support your retirement. You must understand and accept the risks associated with investing if you want to pursue assets that can yield higher returns. Risk exists in all investments. Even real estate, which is regarded as the asset with the lowest chance of failure, witnessed its value decline during the financial crisis of 2007 to 2008. You might be wondering how you actually earn money if all assets are subject to periodic value declines. In theory, the idea here is clear and simple, but in reality, many have faced problems. Your key area of interest is long-term profits on your investment. As a result, you don't need to be concerned about sudden price changes. These brief variations are a result of a phenomenon called random walk. You don't need to focus much on them. You must give your investments a chance to recover if you want the deck to be stacked in your favor. Theoretically, we all know that resisting your feelings and getting through your worries are the remedies. But in reality, this can be a little challenging. To reap the benefits of long-term investing, you must be patient and give yourself time to recover from short-term setbacks. Let's talk about investments. Art. First, be aware of what you're purchasing. A lot of paintings will have a history, and auction houses thoroughly inspect works before putting them up for sale. Long-term stability is criterion number 2, for which the art market takes pride at. There is evidence showing that returns in the art market are generally unrelated to stock market returns, as shown by both recurring sales and regression models. Since art has long been hailed as an inflation hedge, its stability is becoming more and more important with U.S. inflation rising. The final point is about returns. Artworks can appreciate by hundreds or even thousands of percents, and contemporary art has indeed outperformed the S&P 500 over the previous years. In addition, a limited group of art investors who invested with masterworks have enjoyed net returns of over 25% for the past 4 years running. It is the first market for buying and selling fractional interests in pricey works of art from Picasso and Banksy. Consequently, you don't need to spend a fortune to add art to your portfolio. Next, we have stocks. The stock market is frequently seen as the key driving force for long-term investment. Owning stocks has a number of benefits, including the fact that they are paper investments that eliminate the need for property or business management. They stand for ownership in a business that generates money. Over time, the value of stocks may grow dramatically. You can reduce your risks by building a diversified portfolio. Dividends and capital gains are included. You may well be interested in 2 distinct types of stocks: growth stocks and high dividend stocks. Companies that belong to the growth stock category don't pay out dividends to shareholders. Instead, they reinvest their profits in business expansion. Long-term capital growth will be advantageous to the investor. Investors who desire less risky and more reliable returns should choose high dividend-paying companies because they are more mature in nature. Mutual funds. The benefit of a mutual fund is that you hire experienced managers to look after your money. Your money may be invested in a pool with 20 to 30 companies by a fund manager. This also includes the investments of other people. Different mutual fund managers have different levels of success with active management. Actually, the majority fail to outperform the market. For up to 5 years, only around 22% of mutual funds outperform. ETFs. Just like mutual funds, they are an investment portfolio made up of stocks, bonds, and other securities. ETFs, on the other hand, are passively managed and invest in an underlying index, unlike mutual funds. Due to the fact that mutual funds employ an entire team of skilled wealth managers to handle the funds, the management cost of ETFs is substantially lower than that of mutual funds. In light of this, EFTs are a suitable option for you if you're wanting to effectively replicate the performance of a benchmark, such as an index, and you want to reduce the management cost to a minimum. Long-term bonds. These securities, which are interest-bearing, have terms longer than 10 years. The interest rate on bonds is typically what makes them so appealing. They provide a greater rate since they are longer in duration than short-term instruments such as T-bills or repos. Over the past years, the typical long-term yield has been between 6% and 8%. Robo Advisors. Many inexperienced or novice investors may decide to invest here, primarily because the Robo Advisors manage all of your investing for you. Simply fund your account on a regular basis, and the platform will take care of managing your portfolio, adding new investments, reinvesting dividends, and rebalancing your portfolio as needed. Real estate. Rental revenue is one of the main sources of income for real estate. Up until 2007 to 2008, it was thought that real estate was one investment that hardly ever had a value loss. The financial crisis, however, changed everything. But despite this, real estate will eventually recover, and long-term investors will benefit from favorable returns. Annuities. An annuity is an investment agreement you engage in with an insurance provider. You invest a set volume of money, either all at once or over a predetermined length of time, and the insurance company agrees to pay you a specified amount of income in return. This agreement may be for a set period of time or for life. Tax-free retirement plans. Roth IRAs deserve special attention. This is because it provides retirement income that is tax-free. Yes, you heard that right, tax-free. If you have been a participant in the plan for at least 5 years and you start taking distributions at age 59 and a half or older, all withdrawals you make from an IRA are tax-free. An investor's long-term earnings may climb exponentially as a result of the compounding effect of these tax reductions. The takeaway here is to always think long-term, especially when it comes to investing. It's truly one of the best ways to build wealth over time. That concludes today's video, which we hope you enjoyed and learned something from. Give it a thumbs up if you liked it, and consider subscribing to the Inlet Financial Coaching channel if you haven't already. Thanks for watching, and we'll see you in the next video.